prices, and we actually quite like them, and happy to go into the reasons why afterwards with you. With respect to what we look for a manager, it's really, there's no official track record that we need. It's really ultimately a track record of achievement. That's what we look. It's a very qualitative aspect to manager due diligence, but it's important that the manager has a record of achievement, and I think crisis experience is the manager experience that we're looking for. Just to touch upon some of the other asset classes, Al mentioned secondaries. Gamma Consulting has been very, very active in the secondary market. I've been involved with 11 different secondary transactions in the private equity market. Essentially, long story short, buying LP commitments at 50 cents on the dollar, sometimes fully called. We also like, within straddling the private equity and hedge fund space, lending, particularly in Europe. If you looked at some of the deals for secured lending in Europe, it's highway robbery. I don't think it would even be legal in this country to lend at those rates. So that's very interesting to be a lender in Europe. And lastly, in real estate, we really like the U.S. I mean, I do have the benefit of traveling all over the world, and every time I go somewhere else, I just sit there and I can't believe how expensive it is. So, U.S. real estate it still seems to be one of the cheapest asset classes that we can find.
Brett, your take on, from an investor perspective?
We don't do hedge funds. How would you like me to address
Well,
that?
specifically from a futures, when you make recommendations to clients, how what kind of systems do you run? Is it 20 commodities, 30 commodities? How do you, in terms of the futures market?
Okay, great. Well, first we customize everything for the particular client. So it would really depend on the client's needs. But as an overall perspective, we look to build diversified portfolios that maximize the reward to risk ratio, where we get as much correlation, not only in contradistinction to whatever traditional assets they might have, but also within the managed futures portfolio, we get as much diversification as we can in order to really have the ideal efficient frontier for the investor.
So you have short-term systems and long-term systems that you run?
Short-term systems, long-term systems, systematic traders, discretionary traders, specialists, very diversified traders, as much variety as we can get, keeping up the quality of the portfolio, and the traders is the primary, directive.
Interesting. General question, sort of a follow-up on the alternative investment topic. Do you, from a family office perspective, is the manager selection process any different than a pension or endowment? Al?
Yeah, I probably shouldn't answer it, just to save myself. So I'll answer it generically. I think it's evolving. Having been in family offices and happily out of family offices, you see a wide variety of processes. I think the key thing is origination. So if you're a client of a family office or a multifamily office, or if you're setting up your own, the unsolicited two cents of advice is I would spend most of my time on the quality of my origination. It helps when the fat part of your funnel is populated with very good ideas that ideally fit into your top-down view, if you have one, and then two are high-quality, high-integrity funds and firms, because you're going to do the work. The analytical work, for the most part, is pretty much a commodity. I mean, I don't fully agree with that, but the Greek side of it and all the stats, for the most part. But you want to spend your most valuable asset, which is your time, with the best ideas. So to answer your question in a diplomatic way, I think there's a wide dispersion of how origination happens across these. If you look at some of the leading endowments and you wonder why historically they've had great returns, is because that part of the funnel is pre-populated with great ideas from relationships, from their board members, investment committee members, experience, what have you. And then they spend a lot of time on only the best ideas. If you look at some of the newer entrants and some of these pension plans that are investing directly because they want to save the fund-to-fund fees, that would probably be number 2 on my landmines in the next 3 to 5 years. They're putting out hundreds of millions of dollars, very, very thinly staffed. It's probably easy to argue not properly staffed from a human capital experience base either, but they want to save the 1 in 5 or the 75 bips on the fund-to-fund fee, and now they have to take, a 3% to a 5% allocation, which could be hundreds of millions of dollars. Well, how do you start? So that's really where I would answer the question of this dispersion in process and that origination engine. It varies dramatically, and regrettably, you don't find out until 3, 5, 10 years down the road, and you wonder why you can't make the pensioners' bills, et cetera, et cetera.
Interesting. Shalin?
Previous to the family office that I'm at right now, I was at a fund of funds in New York, where I was a portfolio manager for several flagship portfolios of the firm. It was a difficult transition to come down here because, when you're at a large multi-strategy fund of funds with billions of dollars under management, you can essentially kind of walk in and storm into managers and create your terms and meet with the PM, at will. So the difference at a family office, of course, is with smaller assets, of course. We've had to gravitate towards smaller managers. And so I think that's the biggest difference. And the reason we gravitate towards smaller managers is there's a lot of studies with respect to smaller managers, outperforming larger managers, assets, crimping performance. But for me, it's actually one of access. I want to be able to pick up the phone and call the portfolio manager at will or deal with a senior analyst at the firm and ask the question that I need answered. And I don't want to be filtered through multiple investor relations people, and so that is extremely important to me because there's just when you're at a small firm and you're investing in a large firm, the fact of the matter is that I don't think they care about you too much.
Emmanuel, on the PE side, how do you guys pick your funds?
Yeah, I fully agree. Actually, access to the managers is crucial, and that's also the reason why we have investments into some of the largest hedge funds via the equity stake. So we have access directly to them instead of being just one other investor.
So then access gives you the ability to have some level of influence, or at least get information that you may not get as readily.
Well, you get the same level of information, but just you have it when you need it.
Okay. Interesting. Along the same lines, how do you gentlemen view risk management? That's a buzzword that's used quite a bit, but in practice, what does that mean from how you evaluate managers to how you manage portfolios? Brett, in your case with the futures, how do you guys look at risk management?
Again, non-correlation and great diversification within the portfolio is an important aspect of that. And really, vetting our managers very well to begin with is a great aspect, or a very important aspect of risk management. If every single manager within the portfolio is doing a great job of risk management and you have proper diversification, then you pretty much solve the problem as best as you can in the real world.
So how do you, from your perspective, define what from a manager perspective, is it track record AUM, and from a risk management perspective, is it stops, is it some sort of tail hedge? How do you evaluate that aspect of risk?
Because we deal with so many different styles of traders, it's really different for every type of trader. I have a strong background in designing systems. I've been testing algorithmic trading systems for over 20 years. My PhD is in psychology, so I really do a deep dive into the managers, analyzing their personal psychology, analyzing their system, and every type of system requires a different type of good risk management. I just make sure that for a particular type of manager, they have that type that they require in place. If they mismatch their risk management with their trading style, that's a problem. They'll just get me to walk away from a manager.
That's interesting that you look at the psychological aspect and how that matches up with the trading component. Interesting. Shalin?
I look at risk management in a much different way nowadays. I really look at it in terms of the asymmetry of the portfolio. I think that the only way you can really understand a fund investment is to go in and dig into the actual positions in the portfolio, and that requires obviously some level of market knowledge in order to grasp that. So we will educate ourselves on markets that we don't understand, because we don't understand everything. There's always new things that are coming up, and we will dig into actual positions and go through the underwriting with our managers so that we understand what the level of asymmetry in the position is. What we don't like when we invest in managers are managers who invest in what I call coin flips. These are just essentially binary situations where I'm buying, just to make it easy, I'm buying a stock at 20, my target is 27, and I think my downside is 13. I mean, that's just not something that we like, and we don't consider that good risk management. It's not a quantitative approach for us.
So do you view stops and macro hedges and things like that, because some institutions don't like strategies where the risk management is a certain stop,
I think those things are ridiculous.
Exactly.
Yeah.
Exactly. Al?
So on risk management, the philosophy has really been simplified to a couple of points. One is from our view, risk management really starts at the beginning of the investment process. The superficial differentiation is whether it's risk management or measurement. Many managers, when they present to you, it's clear that their risk manager is a risk measurer. And being in the multi-manager space, we've sort of flipped that around and said, look, to be an effective risk manager, it really starts at the beginning of the due diligence process, which to me that means it's integrated with what our top-down thoughts and views are. Because if I have a well-formulated set of top-down views, macro views, points of views, conviction, then I can do two things. I can actively seek those risk exposures that I believe I'll get compensated for. So I'm seeking those managers and strategies, and at the same time, I'm going to actively avoid or mitigate those risk exposures that I don't believe are well-compensated risk. So, going into '08, if you were stretching for yield and you were levered and you had lots of credit, which was a liquid, ex post, and you could argue ex ante, that was uncompensated risk. Going back to the direct lending point, personally, I hated direct lending going into '08, and over the last 2 years, 3 years, I actually made investments in the direct lending space because, to Shalin's point, it has become well-compensated risk. So risk management to me really is at the beginning of the process, and then once the family office has built the portfolio, it's an ongoing process, which to me the opportunity there is really a human capital or a staffing issue for many family offices and private investors is, okay, now my portfolio's built, how do I actively stay on top of it and manage those risk exposures, because the portfolios change, your macro views change, you would think. The dynamics of the global markets change. You may have access to a manager, going back to the earlier points, but maybe you don't want that manager in the portfolio, or you want to change the size, you have a change in sizing. So risk management really is an ongoing process in my mind. And again, I think going forward, both from a family office perspective and then from an institutional management perspective, I think it's a key opportunity set for differentiation and actually outperformance.
I agree. I haven't seen a pitch book where they haven't said that their risk management process is superior and proprietary. And if you look at the history, or should I say the results, it's certainly counter to the fact that these risk management systems were superior and proprietary. Emmanuel, from a perspective of private equity, how do you guys manage risk?
Well, I would say that risk means different things to many people. I mean, if you take the private equity side, it can be risky because you're in like for 10 or more years, maybe 5, well, depends. But at the same time, you can be into a very safe environment where you will only buy things at a very large discount, where there is almost no risk buying because you buy at a price which is already intrinsically inferior to the current price. On the other side, we also appreciate that for some strategies, like the CTAs, for instance, they tend to think more and more into unit of risk as a philosophy for investments, which we also like very much because it's a sign that we actually are on the same page in terms of managing those risks.
Interesting. Yes, sir.
So going back to that, and I think you bring up a good point in terms of risks and private equity, our view has been, and we continue to have going forward, that there's a well-known risk in private equity, which is the illiquidity risk. So I make my commitment 10 years, you have my capital. And for us, the view is, okay, well chosen, it could be interesting in a portfolio setting, but what's the return profile? Right. And the question and the hurdle, if you will, that I would have on primary LP investments is how do I get comfort and conviction that I'm going to get paid equity or equity-like returns, ideally, and then some illiquidity premium because you have a 10-year call on my client's capital that the only way to get out of is selling it to this guy for 50 cents on the dollar, and that's I'm going to get another business card. So that's not going to work. So the challenge to you and folks in private equity is, fine, we'll make the allocation, but how do you give us high level of conviction that in a blind pool, I get my equity surrogate returns, and then you got to pay me for that illiquidity?
Interesting.
Well, in a sense, you try to avoid black pools. To start with, and well, what you try to do is basically to find a management team which actually also invests, so they will give you more information, and they actually are prone to explain how they do it because they love doing what they do. So as I said, relationship with those managers is really key to us, access to them again. And yeah, you really want to avoid any black pools. You really want to be either active into the investment process or at least a facilitator of it.
I wanted to touch upon that as well, if it's okay, because it's an excellent question, and it's something that I grappled with when I first started working on private equity. And I agree with Emmanuel in the sense that I think there's a persistence to management quality in private equity, and which I think can be encapsulated when there's a process, and that process, the repeatability of that process, I think, is very self-evident with the good private equity shops. In the liquid space, it becomes a little bit more difficult because liquid markets are much more volatile. And because you don't necessarily have that long time horizon, it can cause managers to do really stupid things at the worst possible times.
So if I may interrupt you, are you saying that in the hedge fund space, consistency in management is not as, or should be as valuable in terms of a process as it is in
the manager
private equity?
can tell you that they have a process, and you obviously need to ascertain whether that process is repeatable when investing in a hedge fund. But I've just found it infinitely more difficult to encapsulate versus private equity fund managers who, if the team has been there, they've been stable, the previous fund was successful, you can figure out the drivers as to why they were successful because you've interviewed the team and you're not investing in a blind pool per se, then I think that there's a much better repeatability. And it's evident in the results and the dispersion amongst first quartile versus fourth quartile managers in the private equity space.
At this moment, any questions from the audience, by the way? No questions? Yes.
You mentioned earlier that you sometimes allocate to manage futures or strategies that are both systematic and discretionary for one same client, for one same vehicle, is that right?
For one client, we would very often have different strategies, discretionary and systematic in the same portfolio, yes.
How do you balance the allocation between each of those? What are the triggers and the thought process around that?
Balancing the portfolio, once we've decided on the right components of the portfolio, is very much a mathematical process. We look at past performance, correlations, understand the differences between the different systems that are involved in the portfolio, evaluate how likely those are to be persistent, and then we do the math and allocate that way towards whatever gives you the best efficient frontier for the overall portfolio.
And then you probably rebalance, right?
We rebalance every quarter. We look at it every quarter, and we look at it actually every day in a sense, because we're always, looking to reevaluate, is there something that we should change? We pay very close attention to it, but if we haven't changed anything, we do a deep dive every quarter.
Any other questions from the audience? Some topical sort of subject matters. Gentlemen, I'll just throw these out there. Gold, what do you think? Bubble, no bubble? Long, short?
We've in the past 3 to 5 years, I've had it in asset allocation models, and it's always been a client-specific decision. Even when we've had discretionary mandates, it can be an emotional, yes, I believe in it, and no, I don't. I was on a panel yesterday up north, and there's a gentleman who definitely was a gold bug, and his thesis and his argument was very, very well laid out, but you could probably rebut every slide with a counterpoint. So in our models today, we don't have gold as an allocation. We've been working on, let's say, a real asset portfolio with, let's say, 4 to 6 line items, and in that pro forma portfolio, gold would have an allocation of maybe 10 to 15%, but I'm more of a fundamental-based investor, so it's always difficult to have a high level of conviction.
We have a lot of physical gold for sale, but we buy collector's watches in gold. So, and at the same time, we have a few co-investment going on with gold mining. So, all in all, I would say long process of gold on the gold area, but quite short on physical gold itself.
Okay. Shalin?
It's very tough to understand what the true value of gold is, but and we don't have very much of it in our portfolio. But I will say this: that gold does tend to do well in negative real rate environments, and more countries in the world. At first, it was just Japan, then it was the U.S., then it was Europe. More and more countries in the world are just simply devaluing their currencies, and there's a race to the bottom. It looks like in terms of fiat money. So, in that context, gold is probably not a bubble because the fundamentals are very well justified. It probably is one of the few asset classes out there that has the potential of being a bubble, and so I think that's a bit of the house view.
Okay, Brett, any views?
Not one that I would trade off of. We have many different systems we deal with, and I'm sure that there'll be opportunities both long and short gold in the near future and the long-term future with all the systems we trade. My personal opinion is similar to Shalin's, that with fiat currencies being constantly devalued, we'll probably see a lot higher prices on gold over the long term, but I wouldn't go long based on that right now. I'd wait, and I really wouldn't trade based off that opinion anyway.
Okay. Well, thank you, gentlemen. I want to thank our panelists for participating this morning. I'd like to thank you guys for being a good audience, and this concludes our panel. Thank you. I believe the one-on-one meetings are scheduled to begin.